Okay guys, so I'll just add a quick video on how to do the vertical analysis part for your income statement. Okay, so I'll just write out the quick income statement. We got revenue, then we got cost of sales, then gross profit, then we got your employees, other expenses, then your total expenses, right? Expenses. Then we got your EBIT, tax, and ultimately net income. Okay? So we'll peg let's say historically our revenues were at 50 million. Okay? And our cost of sales was known to be like 40% of that. Okay? So there, 40%. You got cost of sales is 40% of revenues. So when you do your gross profit, it's basically your revenue less your cost of sales. Right? Your employees were historically known to be, let's say, about 10% of your revenues, right? And then your other expenses were historically known to be about 35%. I think that's what I put last time. So I'm just going to multiply that by 35%. Alright? And then your total expenses will be equal to the sum of your employees and other expenses. Your EBIT is equal to your gross profit less your total expenses. Your tax is equal to your this times 0.3. Okay? Your EBIT times 0.3. And ultimately your net income is your EBIT minus tax. So basically, this is called vertical analysis because everything is in relation to your revenues in a vertical manner. So vertical manner, everything is in relation to your revenues. Okay, so what things were related? This was at 40%. Okay, employees was at 10%, and other expenses were at 35%. Okay, so ultimately when you get your EBIT, it's actually going to be about, what's this, 15% of your total revenues. Okay, so when you're projecting forward, again, just going to multiply this by 1.05, right? And then you just have to drag all the other formulas because they're all related to your revenues up there, right? So this will always be 40%. This will always be 40%. Employees will always be 10% of your revenues, and so on and so forth. That's just basically it. Thanks, guys.